Okay, yeah, I think we should go ahead and get started. Welcome to the second session of the PPM Attorney Capital Forum. I'm your host, Darren Mangum, Securities Attorney. I'm the managing partner of the law firm of Mangum and Associates. Mangum and Associates is a nationwide securities law firm. We practice internationally as well. I'm sitting in our Puerto Rico office and glad to join the forum today. We've got a few people coming in. I've got some questions coming in, and we'll hold the questions till the end of the session. What I wanted to do is go over today's topic, the 7 key considerations when raising capital, and for forum members who are joining us, each video will have a downloadable not a spreadsheet, but a PDF document that basically summarizes. You can actually, if you're already logged in, you can download that or open it up and follow along. But I'll be covering these seven key considerations in this session, and at the end, we'll open it up to address some of these questions. We may not be able to get all the questions specific to your particular circumstance, but you can always send those in, email those in as well. Also, I'm happy to announce that some of you may have been responded to an email regarding a capital fundraising group that we're working with through our affiliate M&A Client Services LLC, which is the publisher of the forum. It's an affiliate of the law firm, but obviously, as I think the disclaimer points out, unless the law firm is engaged as your securities attorney, what we're talking about in the forum is general information. Not to be construed as legal advice, but certainly hopefully valuable to you, whether you're a client of the firm or not. Certainly if you feel like you need securities counsel, the firm is ready, willing, and able to help in that regard. But anyway, hopefully this is helpful to you. Maybe you've already got securities counsel. Maybe you've already tried to raise capital, or you're in the process of raising capital. We hope that the forum is a great resource for you as well. And at the end of the session, we'll definitely be introducing you to that capital raising group. And or if you can't watch the whole session, you can certainly send us a contact us, and we can put you in touch with them. But anyway, let's go ahead and get started. And basically, the first key consideration is understanding your capital needs. I see this happen a lot with clients who they don't, even when they go out to raise capital, they don't raise enough capital. Even if they hit their targets, it doesn't seem like it always seems like projects, companies, they tend to burn more capital than initially expected. And so understanding what your objectives are, let's say, I've got working on a client right now that they want to raise $1 million for real estate, which is great, a great way to get started in real estate. But when I looked at their overall objectives to invest in not just one property, but several properties, I was like, well, looks like, we could write the PPM for $1 million, but, just on the face of your business model, that's not going to be anywhere near enough. And, again, the rules when it comes to raising capital, all the legal requirements are the same regardless of whether you're raising $1 million or $100 million. To us, it's a matter of zeros on the end. But really identifying, what exactly do you need, how much money do you need to execute your plan, and then also a timing, right? Maybe your overall 5-year plan is, $100 million, right? But obviously, if somebody gave you $100 million today, Would you be able to deploy that immediately? Most likely not. And at what valuation, right? And so certainly sometimes it makes sense to understanding your capital needs in terms not just in dollar amounts, but also in terms of timing, and then also the types of capital that you might need. And we can get into that a little later, but whether it's a debt, whether you need debt that could be immediately repaid back through cash flow, or whether it's more of a long-term equity type investment, or possibly some combination of both. That's certainly part of that overall plan. But obviously, understanding your capital needs as a general rule is more than just figuring out, picking a number out of the air and shooting for it. But certainly going through, at least on paper, or at least on a calendar, hey, how much do we need over this 6-month, 12-month period of time, and what are we going to be using it for? All that's going to be part of the process. And so certainly that's the first step, or not the first step, but one of the key considerations, right? Also, the second key thing is building a compelling investment case. I mean, investors, they're just like anybody else. They've got lots of demands on their time, lots of demands on their attention. They can invest in a lot of different things, and so really, you got to really put yourself in the investor's shoes. Why should they part with their hard-earned investment dollars and invest in your particular deal? And so, obviously highlighting the selling points, the unique, maybe the market potential, the business model, what makes your whether it's a real estate project, whether it's a startup company, what makes it compelling? What would cause them to say, hey, maybe this might be a winning investment? And obviously that's part of putting that. And what's the story? What is your story? Do you have a compelling story to tell? People like story. Investors like a good story, and hopefully it's a true story, right? You don't want to make anything up, but certainly you need to paint the picture. What makes it compelling for the investor, and that kind of feeds into the third key consideration that we're talking about today is targeting the right kind of investors, right? Based upon the type. I mean, there's lots of different types of investors. There's large institutional type investors. There's small mom and pop non-accredited investors, and also certain investors are obviously more lean toward different types of industries. If you're talking about raising money for, say, a cryptocurrency or a token type offering, that's likely not going to cater very well if your target investors are all, people that are maybe 50s or 60s or 70s and that are looking for maybe long-term retirement cash flow. They're not the right kind of investors. Number one, they're probably not a suitable investor, but certainly they're not the kind of investors that really should be looking at your deal, nor will they likely look at your deal, because again, if it's again, you would need to tailor that sort of technology and not always. I'm not saying you couldn't have a successful raise with those kinds of investors, but certainly you want to target the investors that are in line with your particular niche market, right? If you're dealing like with oil and gas, for example, that's another kind of industry that's sort of high risk, high reward, and targeting more conservative real estate type investors, or and always there's certainly speculative investors in real estate as well, but it's just a different type of investor, right? Now, oftentimes the investors may be people that you just have a connection with already, and the only thing that sets them apart is that they know you and they trust you. Okay, that goes a long ways, right? If they know you and trust you, yeah, they may be, some may be more risk adverse than others. Some may be have different kinds of investing experience, but certainly if they know you and trust you, and you got a good rapport with them, then maybe they are the right kind of investor, right? You obviously have to start somewhere, but obviously sitting back, just like you would, again, like we were talking about earlier, just like you would sit back and say, okay, let me put my investor hat on, and would I invest my own money in this deal? Put yourself in their shoes. Do that for the same thing with the right kind of investor. Let's say you raise your $1 million. Well, it's a lot different raising $1 million from, one or two large accredited investors than it would raising it from, 1,000 small non-accredited investors that all put in just a few dollars a piece, right? What do you want your cap table to look like after the fact? And sometimes you have to look ahead, right? You have to look ahead a little bit. What is my company? What is my venture going to look like after we raise it from these particular investors that we've identified? So you certainly want to identify the right kind of investors, and that also feeds into the fourth consideration we're talking about. If you're following along on the outline, structuring the capital raise. Certainly, structuring is important depending on the what is expected. What is the economic case for this particular venture? What does that look like? If you've kind of put down even a simple pro forma, let's say we raise $1 million, $100 million, or whatever in between, and we let's say we hit a base hit, or let's say we hit a home run. Let's say we strike out. If we strike out, then obviously everybody loses, and the whole deal is off, right? But let's say we hit a base hit. Let's say we got a double, we got a triple, we got a home run. Under those certain circumstances, what does it look like when it comes to the actual money that's needed, right? And so, if you on certain kinds of deals, maybe debt is the answer, and then sometimes if say cash flow is going to be many years down the road. It's more of a longer term type investment than certainly looking at an equity type investment, something more long term, and that obviously plays into the kinds of investors that would be interested in this. Somebody that's looking for immediate type income is not going to be very excited about a limited partnership that has, say, a 5-year term without any sort of distributions, and that with a long investment horizon, they're not going to be without any sort of distributions, they're not going to be interested in your deal, right? And so looking at what those structures look like is important, and then again, feeding into that is point number 5 that we're covering, and that is when it comes to what is the investor's expectations, and as far as valuation is concerned, if they're buying your stock for $1 today, and let's say you're able to hit certain milestones, what does that look like 1 year, 2 year, 5 years out on, like I said, like a base hit? What would that potentially look like? Are they investing today at $1 with the expectation that maybe in 1 year, 2 years, 5 years, it's worth $1.50, or if it's worth $2, right? Then that's certainly something that should be supported by your economic forecast, and that way you're setting reasonable expectations. And even if you think that, oh yeah, I can probably double or triple our money within a year or 2 years or 5 years, or if you, based on the numbers, if you really feel like that, hey, I really think I can deliver double digit rates of return, then maybe you need to scale that back a little bit, because obviously you don't want it to be too you don't want it to come across as being too good to be true. Again, managing those investor expectations, where you would definitely want to exceed your investors' expectations and not overblow it so much where, hey, we're going to double your money in 5 years, and then let's say 5 years comes and goes and you're nowhere close, right? Well, then certainly maybe you didn't price it well in the first place, right? And so you definitely want to when it comes to pricing your securities offering, again, whether it's an equity offering, whether you're offering a preferred return, or whether you're offering a debt type instrument, you definitely want to forecast that out, and that way have a reasonable valuation that is very defendable and believable, that fits into your overall story. But then also you want to leave enough runway there that whatever those investors' expectations are, you have a reasonable shot at least meeting those expectations and or exceeding those expectations. So something to keep in mind. The sixth point here, legal and regulatory considerations. This obviously is our bread and butter, is making sure that the securities laws are both understood and complied with. You'll definitely, if it's not us, if it's not our law firm, Mangum and Associates, certainly you need to retain good counsel to make sure that when you are putting together the deal in a way that is compliant with existing regulations. Most likely, again, most people are doing deals under Regulation D or Regulation crowdfunding, or they're even doing both, right? And that's obviously dependent upon what kind of investors you're shooting for, accredited, non-accredited, and what have you. So anyway, understanding the securities laws and making sure, okay, based on this game plan, and oftentimes what kind of investors do we want? That's one of the first questions I typically ask a client. What kind of investors do you want? Because that's going to dictate what investors, what kind of regulations or what kind of exemptions from registration we're going to qualify the offering under. And so, like if we're just doing all non-accredited investors, we want to publicly advertise the offering, then we're going to be looking at regulation crowdfunding. So anyway, that's just an example. But anyway, that's point number 6. And obviously you want to, like I said, retain competent securities counsel to guide you there. And then the 7th point is creating, kind of circles back to the first point, actually the second point, building a compelling investment case. The 7th is pitching the investor, right? Once you've kind of got the story together, once you've got the offering deal together, you've got all your legal in order. Now you're ready to pitch investors, that could be as simple as a very simple pitch deck that conveys those salient deal points to the investor. You want it to be very consistent with your legal documents. We always tell clients, hey, if you've got a pitch deck, we definitely want to see that as soon as possible, because we want to make sure that it's 100% compliant with the legal side. But the pitch deck is really the calling card or the investment. Oftentimes maybe the client, the potential investor, never sees the PPM. You definitely want to have the PPM available, but maybe the meeting you're having, the only time you have is just a quick, hey, here's a quick pitch deck that hits the high points. Maybe it's a 1-page executive summary, but you definitely want to communicate that, and maybe it could be a video. It could be you as the CEO pitching the opportunity in a video. Again, you want to make sure you've got the appropriate legal disclaimers on there, and so that it is 100% compliant, or that it also references back to the PPM for further details, for further disclosure. But yeah, oftentimes the pitch deck is where investors going to make up their mind probably within as little as 30 seconds. Maybe you might have 5 minutes, but they're gonna basically make that decision whether to pass on it or whether, hey, maybe this is something I'm excited about and maybe I want to know more details. But yeah, putting together that pitch deck is something that's super important, and that's something that certainly we can help you do. We've been practicing over 23 years as our law firm, and we can obviously show you examples of different types of pitch decks that have been effective, right, in raising capital. But anyway, those are the 7 key considerations that you definitely want to address. And again, just to recap, if you want to download this form outline, and it hits those 7 key considerations. Anyway, I'm going to go through a few questions that we've been getting. Mike here is asking, when should I do debt and when should I do equity? And that's a great question. Some people don't realize you can raise capital under a private placement memorandum, PPM. You can do a debt offering. You can offer promissory notes, convertible debentures, convertible notes, different kinds of debt instruments. But yeah, I would say, Mike, if you have if the deal is currently cash flowing, yeah, obviously the debt could be structured in a lot of different ways. The debt could be, hey, it's going to accumulate a certain interest rate, 0 coupon, no payments due until maybe the end of the term. Maybe it's a balloon type instrument that matures in, say, 5 years. It accrues interest over that time period, but then it comes due. That certainly could be used. Again, the main problem with debt is that it always comes due at a certain date in time, and not always does it come due at an ideal time for you, because once that date comes due, it doesn't care what the market's doing. It doesn't care. It's just a hard, fast date in time, and whatever's going on with the company, whatever's going on with the markets, and your particular venture, that's just going to be immediately due, legally must be repaid, right? And obviously that's something that an equity offering, you've got the luxury of saying, hey, maybe obviously we're not maybe repaying this debt or repaying this equity. Oftentimes equity you don't have to repay, but there's ways you could structure an equity, like a preferred equity type instrument, so that it can operate like debt, which I would always recommend first before just offering a straight promissory note. But then again, some investors, they like the idea, though, I know exactly what my interest rate is going to be, I know exactly when I'm going to get repaid, and so. I always, Mike, to answer your question, I think sometimes you do both. So you could offer through the same PPM. You could offer both a debt instrument, like, hey, if you give us $100,000, Mr. Investor, we can give you X% promissory note that's payable on these terms, or we can allow you to invest in the long-term aspects of the company through an equity investment. And you can invest that way. Investors like to have choices. I wouldn't offer them a lot of different choices, but at least, hey, if this appeals to you, then this is available. If not, maybe this other avenue is available. So yeah, Mike, you could do. Again, it's going to depend on your particular deal, but you could certainly offer them both debt and or equity. and the investor can't decide, okay, well, why don't you split, 50,000 in equity, 50,000 in debt, and then, that way you're playing both sides of the table. Tamara here, she said, should I avoid non-accredited investors? We get that a lot. Like, I see people, they're like, oh, I just deal with accredited investors. I don't deal with any non-accredited investors. Should you avoid them? Well, I certainly would avoid non-accredited investors, not just the fact that they are not accredited, because lots of investors, the vast majority of investors out there are not accredited. People that are investing in public, the stock market, most of whom are not accredited. Should you avoid them? I would say no, but you definitely want to avoid what I would consider non-sophisticated, non-accredited investors, which means that investors that really have no business in investing in the first place. If they can't, if they're having trouble putting food on the table, or if they're obviously an investor that doesn't have any liquid assets, that they're, I've seen it time and time again where like, oh, this person mortgaged their house and then they went and invested in it. Well, that's clearly not an accredited investor, and not a very sophisticated investor either, because who would do that, take that much risk without on any kind of deal, right? That's just not smart, right? So but oftentimes, sometimes you've got a number of investors that they may not be accredited, but yet they have significant investing experiences. They may have capital resources that are available, and especially if you have a good relationship with them, then I don't know why you should turn them down just because they're not accredited. Some people just say, well, that's just a rule of thumb. I just don't take any non-accredited money. I would say, I would just ask, why is that the case? If it's to avoid, I don't want to get sued by non-accredited. Well, I tell people, accredited people, accredited investors sue just as fast and probably faster than non-accredited investors. Non-accredited investors don't typically have the resources to go hire lawyers and go beat people up. And so, they just may blow up your phone all day long. That might be the case. But yeah, I certainly would, again, going back to our discussion, Tamara, on, what kind of investors do you want, and sometimes, like, for example, your customers of your business, they're a great source to be investors, because they're already your customers. They already like your brand. They're already familiar with you, and so given the opportunity to also invest in you, well, that would be kind of a low-hanging fruit, in my opinion, right? And so just the fact that they're not accredited, why would I avoid that, right? And I would probably, in that case, look for an exemption like regulation crowdfunding or something like that to accommodate them in a 100% legal way. So I wouldn't just avoid them just because they're not accredited, but just certainly be smart about it. Frank here, what do I need a PPM when I'm pitching investors? Okay, yeah, Frank, we talked about, like our last point number 7, pitching. Yeah, if you're pitching an investor, you may not need a PPM. You may not need to present the PPM in that meeting, but let's say you have a meeting, maybe it's a webinar, maybe it's an online thing, or maybe you're in person and you're giving them a pitch deck presentation. You may not whip out the PPM. You definitely need the pitch deck to reference the PPM. We can give you a disclaimer that goes with your pitch deck that basically references back to the PPM. But you wouldn't necessarily need to present the full PPM in that meeting unless the investor says, yes, I'm interested. The main purpose of that pitch deck is to say, hey, this is what we're doing. Are you interested? And the investor says yes. Then the actual selling document which again should be consistent with the PPM, should then be presented and say, okay, well then now based on your indication of interest on this pitch deck, I'm now going to make a legal offer to you through the PPM for this investment. And so you need to have it ready to go in your back pocket, because if the investor says yes, you don't want the pitch deck to be the offer, right? You want the PPM to be the offer from a legal standpoint. And that way, and also that way, if the investors if they say yes and they, okay, here's the PPM, okay, give them some time to review the PPM, but maybe that same day they're ready to go, they're ready to invest. Okay, well, the PPM has the suitability questionnaire, the PPM has the subscription agreement. You can go ahead and close the sale with the PPM in hand. If you don't have the PPM ready, well, you're just sort of talking and, okay, great, yeah, they're interested. Okay, what you don't want to do, Frank, is go out and pitch a bunch of investors and get them to all say yes, 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 and then, now I got to go spend a few weeks, maybe up to 30 days trying to get a PPM drafted and prepared that's ready, that's 100% compliant. And then now I got to go back to the same investors and kind of resell them again. I mean, I guarantee they're going to lose half of them because they nod their head up and down today, and that you got to come back again and sort of resell them all again. I would, you have to be just ready to go. And that way, when they are saying yes, you can say, okay, let's put your money where your mouth is and let's go ahead and close you. Here's the PPM, we're ready to go. So, you don't necessarily need a PPM when you're actually pitching, but it's a darn good idea to have it, right? So yeah, we've got other questions that are coming in. We can address those offline, but again, for those who are joining the forum for the first time, we're giving them a special offer, introducing them to a capital raising source, international capital raising source that has over 32,000 investors, different kinds of investor groups and investors, accredited investors in both the United States and in Europe and in Asia. This group, Marquee Equity, they are based out of India, but they operate nationwide, or not nationwide, but worldwide. And we're happy to set up a meeting with them for you. And again, whether you're a client, because you're a member of the PPM Attorney Capital Forum, we're glad to set up a meeting and make that warm introduction. And so if you just message us through email or through the forum, then we'll gladly follow up with you and set up a time to do that. And so, and again, when you have that meeting, going back to Frank's point, you definitely want to be ready to go. You don't want to just be talking. I mean, you could set up a meeting just to talk about it, but it's better if you already have your PPM ready to go. That way they know that you're serious and that you are camera ready for investment, right? So then you could take the next step and engage them to introduce you to these investor groups. And again, going back to the point of what kinds of investors, family offices, individual accredited investor, angel groups, different kinds of investors they have access to. And so, and they're not the only ones. We have other relationships with other capital providers that, if that doesn't work out, then we certainly introduce you to some others. We certainly want to provide members of the forum with every opportunity possible. Again, whether you're a client of the law firm or not, we definitely want to see you succeed. And so, yeah. So anyway, we appreciate that's all the time we have for the forum today. We will be on here next week. We'll send out announcements. We're doing this once a week. every week. We'll be doing another session next week. And again, if you weren't able to join the forum live today, we certainly have it we'll have it recorded on the forum that you can go back and watch at any time. So again, we appreciate you being a member of the forum, and thanks for tuning in. We'll be in touch. Thanks. Bye.